Today, I'm going to tell you what happened in the stock market this week, why it happened, what's likely to happen in the short term, what's likely to happen in the long term, and the various geopolitical factors affecting everything. This is a very strange stock market that we have. It started off the week with Bill Ackman, the hedge fund manager that Wall Street listens to, and he bet that interest rates were going to go up. And he did that by shorting 30-year bonds. When interest rates go up, the bonds go down. So he shorted them in order to capitalize on the price decreases as the price went down on bonds. As interest rates went up and the bonds went down, he made money, and he made hundreds of millions. He made like $200 million. That set off the week. It was a big week of earnings. It started off with Google and Microsoft. Microsoft came in and reported good earnings, and they shot up about 3% off the earnings report. But then the rest of the week, they just settled down to where they were and just moved sideways. This is a bad look. It's also a bad look when this is the second most powerful technology company, second only to Apple. And Apple more or less played dead for the week. It played dead in the sense of it kept drifting downwards. Meanwhile, Google, it beat on both earnings and on revenue, and it went down. Google was looked at very deeply because they are significant in both the computing area and in the advertising area, as they own YouTube. And the YouTube revenues were good. Their advertising is doing very well. But the problem is that Microsoft is beating Google on their computing because of their artificial intelligence, which is primarily Chat GPT. And that's what drove Microsoft upwards and Google downwards. They have to catch up in the artificial intelligence realm. There is something very wrong with this stock market. I think it's that the valuations on the mega caps, the seven wonderful stocks, Apple, Amazon, Alphabet, which is Google, Nvidia, Tesla, Meta, those valuations have been stretched so high. That's why they need to come down. The Fed isn't going to lower interest rates unless the market crashes severely. I don't think they're even going to lower it if the market crashes, as long as things don't come apart financially. That can happen where the market comes down significantly, but as long as it's done in an orderly way, the Fed actually will rejoice if the stock market comes down. They're not going to run to the rescue like they have in the past. They can't, because the deficit has gotten so high. It's a fantasy thinking that that's going to happen. There's something fundamentally wrong with the stock market, and it's with the valuation, and it's with inflation. The Fed needs the stock market to crash, at least somewhat, to help get inflation down. And this is illustrated with Meta. Meta came out with flawless earnings. Their revenue was way up. Their earnings were way up. But Zuckerberg on the conference call said that they might have decreased advertising in some areas of the world because of the geopolitical tensions. No kidding. But they also might have massive advertising next year because it's an election year, and they're going to have way more ads because of the United States elections going on. They report flawless results, and they went from about 317 down to about the 290s during the week. And that was pathetic. And I think it was an overreaction to what he said. But I think it's also the stock market is screaming that we need to have a crash here. And the Fed will look on with favor if it does crash, as long as things don't come apart with the banks and the financial system. And then to save the week, Amazon came to the rescue. They reported wonderful results, massive earnings, massive revenue. They were good. But there was some worry that there was going to be a repeat of Meta, because initially in the aftermarket on Thursday, they thought that maybe their cloud business should have grown more than it did. That turned out to be thought to be less of a factor. You know, they're making good money on their retail business. People like to emphasize Amazon Web Service, and that is a massive thing, and that's where they make a lot of their money. But they still make $400 billion on the retail service, on those boxes that they deliver to your doorway. It was good to see that Amazon recovered recovered and then went up steadily towards the end of the week. On Friday, the mega caps, they started out, they were roaring, they were going to go up 200 points on the NASDAQ. It looked like a wonderful thing. And people were predicting this the day before. Maverick of Wall Street said it's going to shoot up in the morning and then it's going to gap and crap, which he means by that it's going to shoot up high and then it's going to come crashing down. And it went up like 170 points. It was going strongly towards 200, but then it eventually, I think it ended up about 30 points or so, somewhere around there. My experience was I got into it when it was like at 170, and then I made money as it came crashing down with my two favorites, SQQQ, which is triple leveraged on the 100 largest companies on the NASDAQ. It's a bearish fund. It's triple leveraged to the downside. For every dollar that the mega caps and the 100 largest companies come down, for every dollar they come down, you make $3. And also SORTY, which is SRTY, which is the Russell 2000. It's triple leveraged on the Russell 2000 in a bearish way. For every dollar that the Russell 2000 comes down, you make $3. On Thursday, the GDP came out as 4.9%. Wow. A month ago, nobody was expecting this. This was a wild surprise. And it's driven by all the things the government is doing. It's also driven by our supporting two different wars. The government is pouring massive amounts of money into the economy. Defense stocks like RTX, which is Raytheon, and LMT, which is Lockheed Martin, which build different weapons and smart bombs, which are used in these conflicts, they are doing very well in the last month. They make a sound investment for a world at war. And it's like we got a World War III here, but it's of a different type. The thing that's going to put a damper on the market, and I almost shorted over the weekend. I was going to hold a short over the weekend, but I decided not to just because things are so uncertain with this market. But it's thought that Israel is going to do more of an invasion of Gaza over the weekend, probably because they shut off the internet to Gaza. That is something that you do in preparation for further involvement, people are thinking. So we could, if we have an invasion of Gaza and it's a strong-handed invasion where lots of people die, the market is going to crash on Monday, will be my prediction. I think Biden has been negotiating with them to be less heavy-handed, and hopefully it'll be more of a surgical strike. It won't evolve into Iran getting more involved and other actors getting more involved, where we come into the threat of more of a world involvement situation where we have sort of a World War III, only a very different kind of World War III than any of us ever envisioned in the past. What we really have going on is the federal government is doing the exact opposite of what the Federal Reserve wants them to do. And that is the federal government has just been pouring money into the economy. They do it with the infrastructure bill. They did it with the CHIPS Act to increase the production of semiconductors in this country so that we don't have to rely on outside actors like China to supply them so much. And also the Inflation Act, where it's called the Inflation Act, but really it provides all kinds of money for energy saving devices and ways for people to save on taxes to buy electric vehicles and so forth. That all of that has a very stimulating effect on the economy. It's trillions of dollars that are built in and that will keep coming into the economy as the Federal Reserve tries to mop things up by holding interest rates high. I think possible they might raise the interest rates one more time in December. There's like almost 100% agreement that they're going to hold rates steady on November 1st when they meet and they report their results to the country. I think the Federal Reserve is set on trying not to raise rates, but if the economy keeps storming forward like it is, and inflation keeps going up like it did on Friday, the headline CPI went up 0.4% month to month, and it was predicted that it was going to go up 0.3%. Now, 0.4% month to month, if it does that every month, that's 4.3 4.8%, almost 5% inflation. And that's on top of the ungodly inflation we already have. I've presented Truflation's results in the past, and they say, the month to month is really only 2.4% or something around that area. It sounds wonderful, but the problem is that this is inflation on top of the inflation that's already occurred. I've gotten to where I want to look at the aggregated inflation. How much has inflation increased since the beginning of 2020? And if you look at it that way, from the beginning of 2020 until now, inflation has gone up 24%. Now we're going to add another 5% on top of that. Wow. You might as well say inflation is out of control. And with the federal government keeping spending the way it is, it's going to stay out of control. The Federal Reserve is going to have to hold rates where they are just to keep inflation at 5%, it looks like to me. A lot of that depends on oil prices, and oil prices came down a little bit, but now they're going back up again. They're like $85 at the time of this recording. That's the big fear with the Gaza war. Besides all the humanitarian things and the war and destruction and the god awfulness of it, there's also the price of oil, which is thought to be going up. I don't feel that I can trade individual stocks in this market at this time. And this is not financial advice. I'm not giving you advice on how to trade or what to trade. I'm simply telling you what I'm doing. I can't find my way to trading individual stocks at this time. UPS delivers the things you buy, a lot of the things you buy. And if their business is going down, this is not a good look. And they reported poor earnings. That is a very bad sign for the economy. I think it's a canary in the coal mine that's slowly dying. That's giving us a warning that things are not improving, folks. Please hit the like button and subscribe, because it really helps the channel. What bodes as really bad news on both a short-term basis and a long-term basis is the S&P 500 went below its 200-day moving average. It went below 4,200 and now is on the verge of going below 4,100. If it goes below 4,100, the machines and the algorithms are going to drive market selling, and we're going to be headed down. And as I've heard repeated presenters say, the support levels just aren't there for a long ways down. In the short term, things do not look good. I think we could stabilize if this thing in Gaza doesn't get too much out of hand, and if the interest rates stay where they are. They're not going to lower the interest rates. People have been buying the 20-year bond, the TLT, buying the 20-year bond on the idea that interest rates are going to go down. They're used to the Federal Reserve seeing things breaking, and they rush in to save things, and they lower interest rates to zero. That's not going to happen. He can't do it because inflation is too high. They will never get there if they lower it below 5%. And there's actually a good chance they could increase it to 6%, which is going to hold the market down on a long-term basis. This is the way I roll. You can see from the chart, the line is the 200-day moving average. We are well below that, and we're going to continue racing that 200-day moving average down quite a bit further, I think. That's actually going to be good for inflation from the Federal Reserve's point of view, as long as the banks and the financial institutions hold up. That's always the red card. But even then, I think it's limited what they can do. They could cut it somewhat, but are they going to go to zero? I think those days are over. The last time we had high interest rates in the 70s and 80s, it lasted for about 15 years. That interest rates actually got to zero was the most stunning thing I'd ever seen in my life. I think we have a stronger economy, but it's driven by government spending and the two wars that we're funding, which in the short term can help your economy, but in the long term, it's a detriment to your economy. That's the way I roll. I'm going to keep shorting. I'm going to keep shorting the market generally with these triple leveraged funds that I've laid out for you. Good luck to us all. Thank you.